My name is Hilary Hunt. I serve as director of the Making Sense Project, and today we're going to begin with just a brief introduction to the Making Sense Project and dive into our topic for today, investing in tumultuous times. At the end of today's session, I'll be talking about some additional opportunities that you can take advantage of, as well as sharing the Act 48 and evaluation information for those of you who wish to request that. The Making Sense Project is a partnership between the Pennsylvania Department of Education and Penn State University, and is part of an overall program that is focused on financial education here in the Commonwealth, focused mostly on K-12. Our webinars try to do one or more of three different areas: enhance content knowledge, highlight financial literacy resources, and share professional information. Today, we're really going to be focused in that far left pillar, if you will, on content knowledge, talking about investing in particular, some of the key takeaways and the ways that we can apply those lessons from the last year or so with the global pandemic, and some of the things that have happened since, and use those as teachable moments with our students and or for ourselves. If you haven't already, please go over and select panelists and attendees so that everybody else sees your introduction, where you're from, what grade level you teach, and or subject areas. It's always nice to know counties. That helps me a lot of times to locate where folks are at. I haven't memorized all 500 school districts yet in Pennsylvania, even after I've been doing this for 2 decades. Some of them I still have to think about, but I know the 67 counties. So anyhow, thank you so much. And with that, let's go ahead and dive in. So today's topic is investing in tumultuous times. This past year or so, I think, is definitely what we would consider tumultuous, right? We've heard it referred to as how many different things, right? Unprecedented, all of those types of terms that we've used. But from an investing standpoint, it is one of many tumultuous times that we've experienced in the past, with current events in particular having a significant impact on, in particular, the stock market when it comes to investing. So that's really where we're going to dive in. And I decided, a number of you who have participated in our webinars in the past know that sometimes I take what I call a 6 and 60 format, where we do sort of 6 different topics within 60 minutes. So I decided to organize today's webinar kind of similarly, except that instead of offering resources or sharing different games or videos or resources, I'm going to talk about some of these key takeaways. And by takeaways, I'm really talking about sort of these lessons that we can learn or should have learned, or maybe were reinforced in this past year plus that we've been in, and want us to think about, or encourage each of you to think about how you can use or apply these either sort of right now as a teachable moment, because all of these kids, have experienced a lot of these things, but also possibly thinking about, next year when you're teaching about these topics, to be able to say, hey, remember back in the global pandemic in 2020 when everything, the world sort of turned upside down? Kind of using it almost as a case study, as a way to reinforce some what I would really consider sort of investing basics, but that really, really hit home in the last year. And so that's what I want to talk about and focus on in today's session. So if you didn't see that very first chat message that I put out, I'm going to send it out again. That has a link to our handout for today. I'm going to be sharing a good number of news articles and a few other resources, and they are all linked in that, as well as a link to the PDF of my slide deck for today so that you can access those as well. So let's go ahead and dive in. All right, so we've got 6 lessons in 60 minutes, as I mentioned earlier. This is just a little preview of the ones that we're going to focus on. In an interest of time, I'm going to go ahead and just dive in. So, by the way, feel free to use that chat to ask me to pause, ask any questions, anything that you might have for today. But the first lesson is that sometimes the market, and by the market, I mean stock market, doesn't always make sense. And I'm curious, maybe use that show of hands, that raise your hand feature. How many of you at one time or another in the past year or so kind of wondered, what in the world is going on? I don't understand why the stock market is doing what it's doing. Either, I think probably a lot of us understood when it crashed, but maybe like, why is it rebounding? Why is it already doing so well? I don't understand that the economy is still in shambles, right? That is certainly something that I often sort of was like scratching my head over, right? Like, okay, all of a sudden stocks are rebounding, our portfolio is doing great, and yet, you know what? You look around and, the job numbers weren't improving. The pandemic is still going. There wasn't a vaccine yet, all of those kinds of things. And you kind of wonder, like, what in the world's going on, right? It was a head scratcher at times, as the slide indicates there. So what did happen? So during the sort of, if we look over the long term, okay, this has three popular indices. So we have the S&P 500, the Dow Jones Industrial Average, which is really only 30 stocks, and then we have the NASDAQ Composite. So this is sort of like a long view, right? Now, these numbers, if you were just to look at the number value, the chart looks very different. So this one says, okay, if we go back here to like 2016 and consider that 0, right? That's like where we started. Then this is those percent increases and decreases, and where it was in relation to that. So we look and say, okay, well, it went up quite a bit in 2018. There was a drop at the end of 2019, and here we are. We went kind of steadily up, and then, what are we seeing over here in 2020? Right? Sort of everything just sort of dropped off again. And so this is where we're focused, right? So this was 2020 when the pandemic really got started, or was first, in particular cases were identified here in the US, and the market reacted. And the stock market, when in particular, when places started closing down and there were shutdowns and what have you, the market responded heavily with a major sell-off of stocks, and stock prices really dropping incredibly. And so here's a couple of different takes on this. So the Dow Jones Industrial Average's 11-year bull run ends. All right. So for those of you who right, lots of you, I'm sure, know the difference between the bear and the bull market, but I always remember a bull's horns are always going up. So a bull run or a bull market is when the stock market is going up. A bear, when it puts its claws out or its paws out or what have you, puts them down. A bear market is one that is going down. So the longest ever bull market for U.S. stocks ended Wednesday. So this is dated back in March 11th of 2020, just a little over a year ago, marked by a 20% decline from the most recent high. So, this didn't come as too big of a surprise, right? We kind of expected that something would happen when, everything sort of started turning upside down. This was an interesting article not much farther out, but this is from May 9th, that is talking about, how, this comes from The Economist, which is out of Britain. So, that in particular, Wall Street and the U.S. stock exchange was already starting to come back. And why? Like, the unemployment is still really bad. It's the worst it's been since they started recording. Other countries weren't getting this same kind of a return. In terms of Britain and continental Europe that it's mentioning here. So what in the world was happening? And this, again, that sort of head scratcher, like the market doesn't always make sense, right? And this is one of the phrases often heard during that time, was that there was a disconnect between what we refer to as Wall Street, the stock market, right, and Main Street. And I just, this comes from that same article from The Economist, and I thought this was a great sort of political cartoon. If you kind of zoom in or take a close look at that, I think it's incredibly clever. Over here on Wall Street, they have the bull market, Golden Pond, the Rainbow's End, Blue Chip Row, excess profit drives, Yellow Brick Road, Easy Street, what have you. It's just kind of clever. Whereas over on the other side, they have let's see, we have repo rise, the downs, reeling. We have uh, the dirt floor track, just kind of interesting. Penniless lane. So anyhow, this sort of depicted that sense that Main Street USA, the average economy of the average city or town or even household was experiencing something completely different than what the stock market was. And so while the stock market was going back up, and in some cases hitting record high after new record high, the rest of America in a lot of cases wasn't necessarily feeling that. And so again, I think that sort of broadens that notion of what in the world is going on, right? Because if you're not seeing it in your own backyard, it can cause that even bigger disconnect. So here we are then by August. This isn't that far out with just 126 trading days. Okay, so remember that's just going to be those days that the market is open. The S&P 500, and the first article was about the Dow Jones. This one's about the S&P, but they were very similar. Closed at its highest level ever on Tuesday. So we went from this huge 20% drop to all of a sudden, hey, everything's back, and not is it back, it's back and better than ever, right? And think about it, August 2020, yeah, things were a little bit better. We'd gotten through the summer, cases were dropping, but lots of people still weren't back to work. We had schools were still shut down in most cases, or opening the year shut down. It wasn't what we would necessarily consider a complete turnaround by any stretch of the imagination. And so again, sort of that head scratcher, if you will. So here, this I think is an interesting graphic from the Wall Street Journal. This is just showing sort of where these different events occurred. So you have number one here. So this is late January, the WHO declaring the coronavirus outbreak an international public health emergency. And then we hit this, obvious huge decline here from the February 19th record down to the 20th, when the Fed signaled that it'll do whatever it can to help the economy. And so this really was, this huge downfall, sort of whirlwind drop. And then again, this, I mean, not, 100% a straight line, it had its ups and downs at periods, but definitely still, an upward climb until 126 trading days later, and reaching again this newest high. And so, really just, sort of an interesting graphic when you overlay it with what else was going on. So here's another article from the Wall Street Journal on sort of, why did stock markets rebound in record time? And they offered 5 different reasons. But I want to show you this by comparison. One of the things that hopefully we take away from this time is that, crashes happen. Corrections happen. So traditionally, a crash is usually, sort of that 20% drop. A correction is usually around a 10% drop. But here we are looking at the fastest turnaround ever from a bear market to a record new high. So we went with 126 days from February to August in 2020. You compare that to other drops and returns, and we see 310 days. So basically, from February of 1966 to May of 1967, that's an entire year plus of time, from December 61 to September 1963. All right, so you're looking at almost 3 or 2 years. These are much longer times that it took for our economy after such a significant drop, and some of these weren't even as big of a drop. We see here the one from the early 60s didn't go nearly as deep as this one did. And yet, it took much longer to recover. So again, for a lot of folks, it left a lot of people sort of scratching their heads in terms of, what's going on and what happened. So there's a lot of opinions about this. Obviously, some of the thoughts from Again, this article from the Wall Street Journal. Obviously, the stimulus package and now packages that have been passed and issuing, cutting checks and sending checks to individual consumers, and all of the loans that were made to small businesses had a huge impact. We've seen a lot of different types of comments in terms of having learned lessons from the past, and trying to, be a little bit speedier or a lot speedier, and as this one says, speedier and mightier than ever before. That in order to do this, you got to act fast and you got to get things done pretty quickly. So that is one sort of explanation for this in terms of these things that may not have made much sense before. That expectations for a strong recovery. So this wasn't the sort of thing that was like a long time coming and, how are we ever going to get back from this, right? Especially when there was sort of this, a lot of really early optimism over vaccination. And then third, the dominance of the tech giants. So the stock market, was not all in shambles, right? Not every stock was impacted negatively, or every company was certainly not impacted negatively by this pandemic. You have a lot of tech giants and others that did incredibly well as a result of this, or despite the global pandemic. So, when you look at, certain sectors were doing just fine, and that gave a lot of confidence, I think, to many investors. This one I think is incredibly, I want to dwell on this one for a minute, and that is the return of individual investors. And so I want to read just a little bit of this. It is impossible to ignore the stampede of individual investors entering the stock market. During the first 6 months of the year, they made up roughly 20% of market activity, nearly double the level from 2010. It's never been easier to trade. So if you think about it, you have in a lot of cases individuals, so there are lots of different individual and family situations that arose out of the pandemic, right? A lot of people, and I don't want to diminish this at all. Certainly, many households were affected by job loss, and many challenges. But on the other hand, there were a lot of folks who were continuing to work. In a lot of cases, they're now working from home, sitting at their desk. In some cases, freeing up money that they may have been spending on, gas, eating out, going out to eat, in general, going out and doing other things. So all of a sudden, in many cases, for a lot of these individuals, their income stayed at the same place, right? And now all of a sudden, in many cases, their expenses dropped. So that leaves a gap, which we would hope would go into some sort of savings, or in this case, investing, right? So people said, hey, I've got the time because I'm not doing anything. I'm sitting on my couch. I can, Netflix or learn to bake, some fancy bread, or maybe I'll finally, learn and get myself smart about the stock market and find an easy way to invest. And nowadays, with so many different apps and so many things that make it easy to invest, we saw this huge influx of individuals who came into the market during this time. And so, and we're going to get to a little bit more with that in a few minutes. But you see, and there's a couple of things that are pointed out in this article. Novices stuck at home, they were, they opened brokerage accounts. They were enticed by these rock bottom commissions, very often being able to trade for almost nothing, and the chance to profit from the stocks, going up and down. We saw this huge tumble. Hey, if you've got money sitting around and you see all these prices drop, we'll talk about that in a few minutes about how you can use that to your advantage. But again, a lot of opportunities. And then this other interesting piece of individuals who are new to investing, getting advice from places like Facebook groups, Reddit, which we'll come back to at the end, TikTok, and all sorts of other places where people are like, sort of making investing cool and making it fun and sharing ideas and sharing tips. Whether or not they were good or not, that's sort of another issue. But you have other things, some different companies that were sort of, making folks really interested in what they're doing. So, one of the ones that's mentioned here is DraftKings. So anyhow, this soaring or return of individual investors was a big one. And then last but not least, they point to momentum trading. So, these different individual investors, individuals that are coming in, really, sort of tagging along and trying to ride the coattails of some of these big, high volume, high rise stocks, and saying, hey, this is exciting. I want to get in on it as well. And the last piece there, individual investors also putting a lot of money into exchange traded funds, and trying to just sort of get in and get in while get in while the getting is good, I guess. So anyhow, so those are sort of five reasons why this took such a short amount of time, even though for most of us, we're looking at the stock market and going, what in the heck is going on? And a lot of times wondering, like, should I be getting in? Should I be putting more money in? Should I be waiting? You add to that then that this is in September. A lot of people that maybe were hesitant about what was going to happen with as a result of the election still coming up. A lot of different things that were going on during this time period. And I want to point out, and I mentioned before that, there's certainly a huge portion of households that, never were able to take advantage of these. We're not feeling that, gap between their income and their expenses, because in many cases their expenses were outpacing their incomes. And I want to just point out, and this graphic, I think, does a good job. It comes from data from the Federal Reserve. The top 10% of wealth holders owned 87% of all U.S. stocks outstanding in the first quarter of 2020. So you look at, how much, this dark blue is just the top 1 percentile, and how much of the total U.S. stocks are owned by those individuals. And then the lower blue is that next 9%, and this is over time from 1990 to 2020. So this is 10% of the wealth holders of individuals in the U.S. That hold the vast majority of all stocks. So again, just something to point out and consider when you're looking at this, and again, sort of that big huge disconnect between that Wall Street and Main Street again. So another big one, we always talk about when we teach investing that you should pay attention to things, right? Buy what you know, pay attention to current events, that demand for different things or supply for different things can certainly influence or impact the success of a company and their stock. And that has certainly played itself out in the last year. And so it's been really fascinating to watch a number of companies. So, I'll just share these graphics. So what do these major events have in common? One is wildfires, the other one is hurricanes, and the third is the coronavirus. They all have winners and losers when it comes to companies and their stock prices. So we see after a hurricane, for example, a huge surge in demand for things like generators, right? And you see when a hurricane is coming, you look and there's no generators to be found. There's no sheets of plywood to be found because people on the coast are all boarding up their windows and what have you, and that has an impact, right? And so the coronavirus, just like many of these other large major events that sometimes can or can't be maybe can't be predicted by much, or certainly not by the extent. We had a very active hurricane season, for example, recently, but there's sort of this predictable notion that things are going to have both positive and negative impacts. So I want you to think for a second, and over in the chat, tell me a company that you either know because you follow this sort of stuff, or would guess saw some significant gains in their stock price during the pandemic, and why do you think that's the case? So go find that chat, and again, select panelists and attendees, and just offer one or two companies that you think might have seen their price go sort of through the roof, or at least increase. Yeah, Peloton, Clorox, Charmin, Procter and Gamble, Scott, Amazon. All of these are great guesses. Zoom, yes, the platform that we're using right now. DoorDash, yeah. So I offer a couple of these questions, and I think we hit on some of those. So when you think about like what has the pandemic done to you and your habits, right? Like we talk about with students, or I've always talked with students about, buying what you know. That, like if you don't understand what a company does, don't, even bother. But think about the things that are happening, right? Like if a company is coming out with the next best, pair of sneakers, then what's that going to do, right? Or somebody's about ready to release some new, great video game. So what did we all do during the pandemic? What can we relate to? Well, a lot of us did a lot more shopping online. Maybe our Amazon purchases went up. We probably streamed quite a few more shows or movies, maybe got an additional streaming service. We might have gotten food delivered if you live somewhere that you're lucky enough to have that happen. I am not one of those people, unfortunately. You may have tackled some home improvement projects. I know that we did a huge landscaping project and pulled out a bunch of old overgrown stuff and went shopping for new things. You're teaching and learning online. Think about the impact of that. So somebody mentioned Zoom earlier. So here's a couple of, there's a lot of companies out there who profited, or their investors profited from the pandemic. So these are 12 that I pulled that did incredibly well. So Amazon. We all know Amazon, right? Chewy, that delivers dog food and cat food and pet supplies. DocuSign. So I was in the middle of trying to sell a house. I was the executrix of an estate for a loved one, and we had just gotten the house ready to go on the market. And all of a sudden, the realtors weren't allowed to go into homes anymore. And everything got crazy, right? We did everything with DocuSign. I mean, I had to show up for closing at the last second, where it was just me and the notary. But I have done so many different documents, signed so many legal documents through DocuSign that normally would have been all done by hand before. Anybody know who Electronic Arts is? Who over in the chat can tell me what EA is known for? Grubhub, obviously, yeah, video games. So if any of you have teenagers at home, or even younger, that a lot of them have spent a lot more time gaming. We in our household have allowed a lot more gaming than we ever have before, because quite frankly, it's how our kids have been able to socialize and maintain their social connections with their friends. Grubhub and DoorDash and those types of companies, Home Depot with the rise in home improvements, Microsoft, in part because of Microsoft Teams, but also in part because of releasing a new gaming console, Netflix, Nintendo, and the Switch. If you wanted to buy a Switch at Christmas, good luck. That was hard. PayPal and Shopify, both taking advantage of all of these small businesses. A lot of times, the ones that aren't, the Amazons of the world, but trying to pivot and make their services and their products available online for folks to be able to purchase and maybe, do a drive up pickup. Both of those services really did well. And then last but not least, Zoom. So I pulled together some prices on this. So if you look at this chart here, I put together these 12 stocks. You can see they hit these lows all on or about the middle end of, or there in February, March of 2020, when things started to fall. And since then, they've all gone way back up, right? So we see these incredible increases in stock prices. So, a little over a year ago, Amazon stock was trading at $2,134.87. Today, when I pulled this, it was at $3,313. So you can see this incredible difference. When we look at who were the biggest winners and losers, oh, and I added this just because I feel you see these a lot of times. I feel like I should have a disclaimer. Yeah, I personally have stock in some of these companies, so these are not an endorsement, and so I just want to reveal that. But some of these stocks did incredibly well. Which one did the best of all of them? You're probably not surprised that of all of these, Zoom did the best with almost a 400% change from February of 2014 to February of 2021. And so you look at this and this $1,000. So this was if you had invested $1,000 in Zoom stock last February, by this February, it would now be worth $4,887. So what does that mean? If you had been like the best, the owner of the best crystal ball out there and had decided to put, let's say, $1,000 in each of these companies. Now, yes, I know Amazon stock is at $2,000. So you couldn't have actually bought a stock of that unless you were to use one of the services that lets you buy partial shares. But anyhow, let's say you had invested $12,000 and seen this with $1,000 in each company and seen this percentage change. What would that total up to? Well, your $12,000 would now be $27,090.78. That's a 126% increase. And that is because some of these didn't increase by that much. Home Depot really didn't change tremendously, but some of these just hit it out of the park, right? So it's when we think back to that reason about individual investors, well, part of the reason that individual investors got into the market was because they're seeing these incredible gains, right? And they're still getting into the market and they're, still continuing to drive some of these gains because, this is exciting. This is, wow, like, hey, when do I get in? If I don't get it now, it could still just keep going, right? So anyhow, again, points that whole notion of looking at current events, looking at, in particular, supply, and in this case, for the most part, demand. And that is just so incredibly important and something that we can't underestimate. Pardon me. So I wanted to just share a real quick secret behind this. So some of you might say, well, Hillary, how in the world did you take the time to look up all of those different stock prices and put that table together, especially with today's dates? So I wanted to share with you, if you've never used it before, a little fun integration with Google Slides is to use Google Finance. And they're not always the most intuitive thing to do, but I can tell you that you can find 1,000,001 videos out there that explain how to do things like this. So here, for example, in this Google Sheet, I have copied in a formula that I was able to find and pull from watching a video and looking up a couple of places online that made me be able to select certain dates and then find the closing price of each of these stocks on those dates. And that makes it so much faster if you ever want to put together a table like that or a chart with that kind of information, being able to pull all of these kinds of things with a formula as opposed to having to go and look at all of them, especially on a specific date. This is an incredibly quick and easy way to do that. And so I mentioned earlier and gave everybody that link to the handout. Linked within the handout is access to this actual spreadsheet. So you're welcome to go in and make a copy of it, and you can go in and select your own, adjust these to have your own stocks and what have you, or the ones that you're picking. A great integration tool that probably some of you, or maybe some of you haven't used or aren't aware of. So just a quick plug for that. So, okay, so stocks, were plugging right along. They were reaching all-time highs, and then all of a sudden the pandemic comes along, and boom, we have this incredible dip or downturn, correction, crash, what have you. So one of the lessons to take away from this is that it's possible to take advantage of that, right? So If you're an active investor, and in particular, if you invest in individual stocks and manage your own portfolio, almost every tool that's out there allows you to put in orders that when something reaches a certain price, okay, that you are then going to buy it, right? You got to have money sitting in the account ready to do it, when it happens. But, I don't know about others, but I know that all of a sudden we'd had a bunch of like buy orders that started going through, and then we had to reevaluate because they've been sitting there for forever. We're like, wait, hold on, I bet it'll go even further down. So, there are ways to take advantage of this because, the old adage is to buy low and sell high, right? So when things start to tumble, you can take advantage of that to get stocks for less. But you want to be careful. And so this is a quote from Warren Buffett that I thought was fantastic. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. So this is great advice, right? Like, who doesn't love a sale? You can kind of almost think of these market corrections or market um, crashes, if you will, as almost like a sale on stocks. Now, it really isn't a sale on stocks. It's just that, by virtue of supply and demand in the market, that the price now has dropped considerably where people are willing to pay for it. But this is referenced in this blog post from the Motley Fool. Should you invest when the stock market crashes? And, a piece of this is definitely, a crash isn't necessarily a good thing. And a lot of us aren't looking forward to seeing our portfolio value plummet. When it happens, you can, if you have investments or if you have cash on hand that you're able to invest, take advantage of that decline in price and pick up some good stocks. And so what's important here is this last piece, which is the key to investing during a downturn, is to make sure you're putting your money behind solid investments. Don't buy stocks simply because they're cheap. Instead, buy quality stocks that are going through a rough patch. So, these are the sorts of stocks that are likely to recover and recover quickly, and you're kind of getting them on sale, if you will. And so, there's different things, especially with students, that you can think about, like, so how do you figure out what a solid investment is or what's a quality stock, right? How do you even research a stock? One of the things that I can tell you in my own personal experience this last spring, we were able to pick up and we purchased a number of companies. We tend to like to invest in individual stocks that are known for paying dividends. And so, those are very often very solid, good, strong companies. So, how do you know if a company pays a dividend and what percentage that will be, and what does it mean to be paid a dividend, and what are some of the requirements? Like, you have to own it on a certain date in order to get that, and how that's calculated. So, a lot of things that you can do in relation to that. So this other one, this is a concept and something that, again, all of these are things that we can, are probably things that we've talked about or taught in personal finance, and especially when it comes to investing, but all of them can be sort of, further honed or further or driven home through the pandemic. And so I always like to point out that, and some of you know that I came to personal finance having been a math teacher, and I love pointing out that graphs can be deceiving, right? So this is a great opportunity to have some fun playing with some graphs. So this is that one that we looked at before, right? 126 days. But imagine, for example, if only ever looked at this piece. Right, so let's take a look at this. So a tool that I like to use is Yahoo Finance. I use a bunch of different tools depending on what it is that I want to do. But one of the things I like about Yahoo Finance is that you have the ability to put in a specific period of time. So this is the one-day closings of the S&P 500 from March 1st to March 20th. If you only looked at this part of the graph, you'd think that the stock market never does well, right? Or, it's like this big, huge downward trend. So with this, however, if you look back, over a longer period of time, right? This is from March of 2020 to March of 2021. This is a very different looking graph, right? And yet it's the same piece of information, right? This just happens to be the portion, this right here, happens to be this little piece, right? That when you look at it, and you sort of zoom in and you zoom back out, you get a very different take on what is actually going on in terms of the stock market. And so it's always something that I think that we should spend some time with students, especially, it's kind of that whole notion of, who do we trust for information? How do we know if it's valid when we look at data and interpretation of data in a visual sense in particular? We want to make sure that we're understanding it and that we, sort of look at all of it. So if you want to look at these kinds of graphs, go to Yahoo Finance. You can click, for example, on the S&P 500, or you can search with GSPC over here. It'll bring you to what it is right now. Go to chart, and then from chart, you can set, for example, custom, or you can go, to a year to date would give you January 1st to today, the last year, what have you. So this is a 5-year look. So this gives you another really nice sort of puts this into perspective, zooming out even further than what we were looking at a little bit earlier ago. Now this gives you the chance to adjust, if you're looking at the close week by week, so it doesn't have quite as many data points, or day by day or month by month. So you can kind of change how those peaks look and have students do some playing around and looking at that. So the bottom line, look at investing from a long-term perspective, both historically and in the future. It's okay to zoom in on a specific time period, but make sure you zoom back out to put it in perspective. Okay, so number 5, I believe, on our 6 and 60 here is investing is for the long haul, or at least it should be. And so, certainly, there's been a lot of interest and a lot of activity in 2020 and now into 2021, and a lot of focus on sort of these short-term gains. But really, overall, investing as a strategy is generally thought of for that long term, because when we look at those at those graphs, right, we look that over the long term, the S&P 500 has done great. If the only time you are investing was from here to here, that would be a problem, right? You would have lost a lot of money. And so when we think about investing, and we talk about investing in particular with students who maybe have experienced this huge crash and maybe are really hesitant, it's important to think about that long-term perspective, and that when we talk about money that we're investing, it's money that we are feeling comfortable taking a risk with and not having to get access to it right away, right? The people who were most concerned when this happened were people who were like looking at retiring then, and all of a sudden saw their retirement assets, and their retirement accounts plummet, right? If you needed to get a hold of your cash that was invested, that was a really scary time period. Now, luckily, we know it only took 165 days to get from here to here, right? It set a new record in, no time flat. But we didn't all have a crystal ball. Hardly anybody had that crystal ball sitting here at the end of March last year to know how long is this going to take, right? So we want to just remind ourselves that investing is for that long term. And so when we think about risk, and I think we focus a lot on that loss of value, and I always try to remind folks that, you haven't lost money until you've sold an investment, right? So that's another lesson that comes out of this. If you bought a stock or bought stocks at, say, $50 a share, and they have now dropped to 25, and you're going, oh no, the sky is falling, the sky is falling. You haven't lost money unless you're selling the stock at $25 a share, right? If you wait and it goes back up, you haven't realized that loss. So realized loss and that loss on paper, where the current value is, are two very different things, and you have to have a certain stomach for that risk and to understand that these kinds of things happen. So there's the risk of that value, and then there's that liquidity risk. Okay, so this is the second piece, that the money won't be there and be available when you need it. So you might know that, hey, if I can wait this out another year, things will probably turn out well. But if I want that money, if I need that money to put a down payment on my house, or that was the money that I was planning to use to put my kid through college, that's another risk. So we focus mostly on that first one in terms of the value, but I just wanted to point out the liquidity risk as the other piece that's awfully important and we don't want to miss when we talk about risk when investing. Um, so again, the long term, that's where it is. That's what we need to focus on. That's what we should be honing in and really talking about with our students. Um, we want to make sure that students know market crashes and corrections happen. They are predictable. We might not know what day or time they're going to happen, but if you look back over history, they happen and they happen frequently. You have to appreciate that fact, understand that fact, and know, are you comfortable taking that risk with your money when you're investing? And also recognize that some stocks and some investments are going to be hit differently or going to, have a very different impact for those kinds of things. And, then there's ways to minimize that risk. So are your investments diversified? If all of your investments are in stocks and you don't have any bonds, if you're not sitting on, still having some cash and, or money in an easy way to access it for your emergency savings, those are all things that you need to think about. And then obviously thinking about, when are you going to need that money? And, the sooner you need that money, the less risk you're going to want to take with that. So all of those are things that we can talk about with students and use the last year or so as sort of that case study with these takeaways to point to and reinforce these. So this sort of segues into our last one, and this is an article from the Wall Street Journal in February. Teens are gambling their savings on GameStop stock, and their parents are worried, right? So the day trading frenzy firing up stocks like GameStop benefits from capital provided by a growing number of teen investors. You have to be willing to lose it all, right? And so I find it concerning that there are a lot of people who are beginning to treat investing like gambling. And I think it's important for us and incumbent upon us as financial educators to make sure that students understand the basic principles of investing and understand the dangers of getting into a day trading where you're looking at very short periods of time and trying to make a quick amount of money, what the implications are on some of that for things like, capital gains tax and other things like that, the risk that's involved in that. And then in the case of GameStop, this is even using more complicated and complex, sort of different topics that we need to think about, like options and all of those. So it is, the takeaway that I chose for this is, don't underestimate the power of organized investors. Okay, so in this case, and I don't have time, this could be a webinar series on of its own to really dig deep into what happened with GameStop. But in short, if we look at, this is year to date of this year, so January 1st or January 4th of 2021 to now, this is what GameStop stock has looked at. I mean, I don't know about you, but it's pretty crazy to see a 52-week range. In other words, the highest that the stock has been and the lowest that the stock has been in the last year, of $3.49 to 483. Not because the company was doing really well, not because it had this great new whiz-bang approach to doing stuff with video games, but because there was a group of investors, primarily on a Reddit called Wall Street Bets, that made this happen. And that is a fascinating and somewhat frightening phenomenon to a lot of individuals and a lot of companies. It's also a very exciting and exhilarating concept to a lot of individuals and companies who can profit from that. So this is, I think, going to continue to be something that we look at. It's going to continue to have ramifications for a long time to come. A lot of people using the app Robinhood to trade. Here again, this is the last year. Okay, I mean, these are prices, back here of $3 all the way up to 483. I mean, it has been insane, right? So there was this interesting article in the New York Times. Dumb money, quote unquote, is on GameStop, and it's beating Wall Street at its own game. GameStop shares have soared 1,700% as millions of small investors, egged on by social media, employ a classic Wall Street tactic to put the squeeze on Wall Street. So here's, and I think it's interesting because they can talk about the dumb money. Destined Individual investors are often derided as dumb money, destined to lose against the highly compensated analysts and traders who buy and sell stocks for a living. But in recent days, this is from January, individual investors, many of them followers of a popular juvenile foul-mouthed Reddit page called Wall Street Bets, have upended that narrative by banding together to put the squeeze on at least two hedge funds that had bet that GameStop's shares would fall. By the way, I went and I took a screenshot of Wall Street Bets. I really couldn't like scroll any further without getting stuff that wouldn't be appropriate. So I would, first of all, not recommend getting your students on Wall Street Bets, or being very, very careful with what you pull from there in terms of some of the language and other things that they're often used. They talk about they talk about GameStop as being part of this meme stock trend, meaning that people were taking screenshots of their portfolio and making memes out of them, creating other memes about how, how this was just taking off and skyrocketing and that, you didn't want to be left behind. This was very much driven by different forms of social media. So, a coordinated effort that before social media, I don't think could have been possible, right? Like you could never get individual investors from across the country to sort of, to do this, to communicate and do things in this manner that that they can now. And so, there's a lot of questions about where this is going to go in terms of regulation and what have you. And I think it's going to be a conversation that in a case study used many, many times over in a lot of different ways in the years to come. So I think it's fascinating. I think it's definitely something to watch and continue to try and do your best to understand. There's a lot of great videos, podcasts, and other things out there that kind of walk you through what happened. Again, it could be the subject of an entire course, really. So I encourage you to go in and do a little bit more on that. But going forward with this, how will this end? Will it? I mean, nobody predicted GameStop stocks to still be trading at the level it was, or a lot of people didn't. Some people did. Still today, or there'll be new regulations. Will this dumb money be viewed differently going forward? Will apps like Robinhood continue to do so well, or are they going to see increased competition from new entries into the marketplace? And how did this increase in interest in investing? So, I know a lot of teachers and others who've said, hey, all of a sudden my kids are interested in this because they are following what's going on with GameStop. So is that going to have a positive or negative impact down the road if, in particular, students think that, hey, everything in investing, is a sure bet, right? Or start to treat investing like gambling? And how do we, as financial educators, help to differentiate that mindset going forward, and that make sure that students truly understand and appreciate the difference between sound investment principles and really, taking a bet on Wall Street, like the Reddit says. So those are my 6 key takeaways and sort of lessons that can be used and applied with the pandemic. I think, as you think about how you can use these ideas and strategies, I encourage you to think not just now, but going forward into the future and thinking about what you can do even next year to use some of these kinds of things as case studies. So thank you again for joining us. I'm going to just remind everybody that we have some additional webinars that are coming up. April 22nd, we'll be doing what's new in financial education. And May 6th, we'll be rounding out this series with a new resource called Million Stories. So thank you, everybody, for participating. It's been great to have you on with us this afternoon, and I hope to see you again next month.